Hello, everyone. Thank you so much for joining us tonight at a Kent District Library program. We're very excited to work with some partners that we really like. So Home Repair Services tonight and Legal Aid of Western Michigan is putting on a 10 home ownership tips for you. So we're going to be doing that program tonight. We'll get to it in just a minute. And it is something that we will have up on our website and archive so you can go back to later as well. Remember that right now KDL is doing a lot of different programs for you, and those can all be found at kdl.org/events. That's where all the different events are. We have some more streaming programs for adults even coming up this Wednesday on a different topic with home repair services, so you can check that out as well. So let's get started with the program, and I'm going to bring Steve Grum. Hello, Steve.
Hey, Kip. How's it going?
Good.
All right, everybody. As Kip mentioned, I'm Steve Grum. I work with Legal Aid of Western Michigan, and we're super happy to partner tonight with KDL, with Home Repair Services, and with the Hispanic Center of Western Michigan on the program. Here's what we're going to do over the next hour. We're going to go or maybe even less than an hour. We're going to go one by one through 10 tips to help people who are either planning to buy a home or already own one. We're going to cover things running from home financing through home repair, property tax issues, concerns about being foreclosed on and what your rights are in foreclosure, and even estate planning for people who are interested in leaving their homes to family members or other folks. So if you have questions during the program and you're watching live on the Facebook or YouTube streams, you can type those into the comments box and we'll get to them at the end of the program. One warning there is don't type anything that you want publicly seen. So keep any kind of personal or private information out of there and keep your questions general. Okay. We're also recording the program tonight, and we're going to produce kind of one-page handout after the program's done. We'll get the recording and that handout available through KDL and through our social media pages in the next day or two, and courtesy of the Hispanic Center, we'll provide a Spanish language translation of the handout too. All right, so let's move along, and before I introduce our presenters, I'm just going to do one quick legal disclaimer. This is my lawyer fine print, which is that while we're super excited about the tips and resources we're going to share during the program tonight, we can only offer legal advice in one-on-one private conversations. So don't take this as legal advice. Nothing we say tonight is legal advice. That's it. End of my lawyer fine print. And we can move along now, and I'll introduce our presenters, Elisa and John. So Elisa Flores is a housing counselor and educator at Home Repair Services of Kent County, based in Grand Rapids. And John Smith is our Director of Strategic Litigation here with me at Legal Aid of Western Michigan. John's also based in GR. Hey, Elisa. Hey, John.
Hello.
Hello.
Alrighty, so without further ado, let's get on into our tips. And Elisa, I will turn things over to you to start with tip 1 on personal credit issues.
Of course, I forgot to unmute myself. Hello, everyone. The first tip that we have is for credit matters. So I want to make sure that that you know that this is very summarized, that there's a lot to say about credit, but this is just kind of a summary of what you should do with your credit. First of all, to clean up your credit score, you really shouldn't pay someone to clean up your credit score. You can do it yourself. It's a lot of work, and it might take a little bit of research, but it's something that you can do yourself. You can also get a consumer report one time free every year from each of the credit bureaus. So you can either space them out or get them all at once. This is something that you can do on your own time as well. Right now, you can get a copy of your credit report weekly until April. There's really no reason for you to do that if you're doing, what you're supposed to do with your finances, which we'll talk about a little bit later too. And then if you have inaccurate information or any collection accounts that are not yours, you should be disputing those. When something is on your credit, a collection account will stay on your credit report for 7 years unless they sell it to someone else, another collection agency. If the account is yours, pay it. You can settle on that account. You can do a lot of things with it, but bottom line is, if the collection is yours, you should take care of that. If you co-signed for somebody and they don't pay, that's also your responsibility. So you should keep that in mind. And then all disputes have to be done in writing, and you must prove that the collection is either not yours or that you have paid it. All of this has to be done in writing. And then a couple of things to do to maintain good credit. If you don't have any negative stuff on your credit, to maintain good credit, keep making your payments on time, because 30% of your credit score comes from paying, your monthly payments, even those bills that don't report to the credit bureaus. It's really important for you to pay everything on time. Keep your balances low on your loans and also on your credit cards. On credit cards, I do have a specific example for that, so that you keep that in mind. So for a credit card that has a $1,000 limit, you should be keeping that balance at 290 or less. So ideally, pay as much as you can for all of those accounts, but just to make sure that you're keeping the balances as low as you can. And then also maintain your old accounts in good standing, because these accounts also help you. For 15% of your credit score comes from keeping those old accounts active and in a positive matter. To build credit, this is the last thing I'm going to say, I promise. To build credit, you can get a secured credit card. So this works as you bring the money to the bank, and that money becomes your limit, and you borrow from that money, but you're basically borrowing from your own money. You can get a credit builder loan. They call them differently at different banks, but basically, the bank takes out a fake loan in your name. You have a monthly payment due. They don't give you the money. They basically just open a savings account for you. And every time you make the payment, that payment just goes into the savings account, and they report to the credit bureaus as if you were making your payment. So it's a really good way to get you started. And then the last thing, you can make extra payments on any loan if you can and when you can, so that your balances are decreasing and your credit score is improving. And then let's move over to John for tip 2.
Thank you. So for tip 2, I just want to talk a little bit about seller financing. And really the basic advice is just to really beware of it. What happens is, speaking of credit scores, a lot of our clients would like to purchase a house, for instance, and they just can't get that credit score up, or don't think that they can, to the point where they can get a mortgage through a bank, or some of the other bank options, HUD or MISTA provide mortgage options, but they can't get that mortgage, and so they do some form of seller financing. Now, when you go through a mortgage lender, it's regulated, and while it's not perfect, there are a lot of ways in which you are being protected that you maybe don't even see. Your lender is regulated in how it gives interest rates to its clients, and so you should not be getting a different interest rate than somebody else who applies. Separate from that, your lender has duties to make sure that it's actually doing a fair deal, because when it lends the money, it needs to make sure it's protected. The money is protected, and so it'll make sure that the house that you want to buy is the value that you want to buy it at. And if you're kind of getting ripped off, then the lender won't allow that transaction to go through. When you go through seller financing, you're losing all of those protections. The interest rate can be really whatever the seller decides to charge you. There is a usury law in Michigan that would kick in, but it's a pretty high rate. The usury rate for secured transactions or for these types of loans would be 11% in general. Additionally, the lender that is providing this financing has no interest in you figuring out whether the sale is a good deal or if the house is in a good condition. And so oftentimes you're buying that house as is and you're responsible for all repairs. And you may be way overpaying the fair market value for that house. And then unlike, it starts to look a whole lot like a tenancy. And in fact, sometimes they are doing those transactions as a lease with an option to purchase instead of a land contract. Both of those are forms of seller financing. But unlike a tenancy, you are responsible for repairs. And that means you've taken on all of the responsibilities of being a homeowner with very little of the rights of home ownership and very, very few of the protections. So I just really caution you. I know it's important sometimes to find that home and to buy a home now. There's a lot of pressure on that, but stay away from these types of financing, whether it's a land contract, a lease with option to purchase, or anything like that. They're really not good deals for you. So I think we're supposed to be switching over to about slide 6, and I'll turn it over to Lisa to talk about the next tip.
Yeah, and Lisa, if I can just jump in real quick too. Thanks, John. Yep, sorry everybody watching. We're having a little trouble advancing the slides right now, but we're going to try to get caught up with the slideshow. And then I think we may as well, as John said, Lisa, just keep on going with tip number 3 right now.
Sounds good. Okay, so tip number 3 is know the mortgage finance basics. So aside from what John spoke about, when you're starting the process to looking into getting a home, talk to a few lenders. Don't stick with the first person that you talk to. And there is a rule when you talk to lenders that you can talk to as many lenders as you want within the same 30 days, and your score is only affected one time. Because every time someone pulls your credit, your score is affected, no matter what. So unless you pull it for yourself. But if someone else pulls your credit, if a bank, credit union, mortgage company pulls it, it will be affected. So just make sure that if you do it, start the process and give yourself 30 days to go through that process. Talk to as many lenders as you want to, and make sure that that they're explaining the process and the programs that they have. You don't want to go to the first person that you talk to just because they're your friend. You might get a better deal somewhere else. So just make sure to look out for yourself, for your best interest. Always request a copy of the credit report. It is your right, and if you do ask for that copy, it is their obligation to give you a copy of the credit report. They might say, oh, no, you don't qualify, or you do qualify. Well, still, request that copy of the report so that you know exactly what's there. If you're denied for a loan, just make sure that you request an explanation of that. You don't need it in writing or anything like that, but you just really want to know why you're getting denied and what things you can do to be approved at some point. And then avoid getting more credit. So once you start the process, you might be approved for, I don't know, $150,000 home. But if you keep adding payments to your basically your bill, I'm blanking out on it, but if you keep adding bills, adding different accounts, then you might qualify for less of a house than what they initially told you. So if you're looking for buying a house, just take those 30 days and only look at houses, only look at a mortgage, as opposed to looking at credit cards and car loans. All of that will affect not only your scores, but also your ability to borrow money. And then another little thing about mortgages, which is the slide number 7, which is a term to know is your escrow. So your escrow account, when you're closing, and this is from the lender, you'll get all the right numbers from the lender once you're closing. But at closing, you bring 1 year of homeowners insurance, a full payment of that, like 1 full year, and a portion of your property taxes, depending on when you close. The homeowners insurance and the tax money is really is paid ahead of time. So you might, when you bring it at closing, they pay it up front so that your house is insured. The lender sets up this account for you, and it's sort of like a savings account. That's the escrow account. every month that you make a payment, your escrow portion for the homeowner's insurance and taxes goes into the account. And that's where the lender will take the money out when the taxes are due and the next year when the homeowner's insurance is due. So this is set up so that you don't have to worry about making huge payments two or one time a year, but that way you just make little payments and then the lender takes care of everything else. So when you're paying your mortgage, you make one check for the whole amount, and then the lender will disperse it to everything, the insurance, what goes to taxes, what goes to interest rate, all of those things will be there. So yeah, and I think that's it for that part. Let's turn it over to John again.
Thanks, Lisa. And our next tip is just to talk a little bit about how to communicate with your servicer. And so what happens when you do get your mortgage loan is that you often will take out the mortgage loan with the local bank or a mortgage company. And then very quickly, you think you're going to be doing business with that bank, for a while. And very quickly, it actually gets transferred to another bank or company to service the loan, they call it. That's just simply the collection of payments, making sure that escrow account gets paid. Sometimes people get in disputes with those servicers, and there is a good way for you to kind of protect your rights, get the information you need, and to dispute information. In legal terms, we call it a qualified written request, but you have the right to dispute any servicing related issues with that servicer, or simply request any information from that servicer. And you do it in writing. And you have to mail it to, if the servicer identifies an address, then you have to send it to that address, but then they have a certain amount of time to respond. It changes a little bit depending on the type of request, but it's about 30 days or so. And so the simplest way to know the address is to look at your statement. It'll be separated out from other addresses in your statement. It's oftentimes on the, you flip the page over, it's on the second page, the back of the first page. But look on that statement and find it. And if you have issues about escrow or payments that are not applied properly, that is the proper way to dispute it with your servicer. Later on, we're going to talk about foreclosures for a second, and just keep this process in mind because it helps when you are dealing with threats to foreclose or payment issues with your mortgage company. And so I think I am going to continue talking about our tips and moving on to the next tip, which is simply, there we go. Sorry, I lost track of this, which is simply to be cautious about additional financing. I kind of think of it almost like a yellow light, red light, maybe. You have a mortgage, you're paying on that, and that is, as you pay down that mortgage, that is paying off your home slowly, and so you're building what's called equity. And it seems like everybody and their brother wants to get you to take that equity and borrow with it, which you can do, you have the right to do, but it's an easy way of borrowing more money, increasing your debt load rather than paying down your debts and, increasing your wealth. And so I'd caution you about taking any loans that reduce the equity in your home. But if you're going to do that, there are a couple of options for you. And again, it's kind of yellow, red in my mind. But the first one is called a HELOC. It's a home equity line of credit. It's a loan that you can get from kind of any local bank that would overlay your original loan. So you'd keep your original loan, and then you'd have a second mortgage that you could withdraw from as you need money. And generally, they will only allow you to borrow a total of 80% of the equity in your home, or maybe they might go up to 90%, including both the original mortgage and the home equity line of credit. So, and those are probably the safest because, again, that second mortgage company wants to protect themselves and they don't want to lend out too much money. Additionally, if you can get the loan and then only use it as you need it, you don't have to take out all the money right away. But I will caution you that it seems like once people have access to money, sometimes they overspend. So that's always the fear there. The second is the cash out refinance. I'd just say beware of that. Though of course it's oftentimes an option for people and a good option for people when, as as we've seen in the last year or so with interest rates dive bombing, even people with a very good mortgage may decide to refinance simply to benefit from lower interest rates now. The problem is that then, of course, the sellers of those loans want you to take out as much money as possible, and so they encourage you to take out all the equity that you had in your home, which they make it sound like it's a smart idea because they say things like, it's cheap money. You can get 1% or 2% loan and then invest it in the stock market and make all this money instead. And you are risking your home when you do those things. And so what we saw from the last bubble was that people use their home to borrow money for things that aren't necessities. And then when the financial markets tank and we end up in a recession, the home is not worth as much. You can't sell it, and you can't pay your mortgage. You get stuck in a position where you get foreclosed on. So just be very cautious about both of those. And then the third one is a reverse mortgage, which if you watch enough daytime TV, you see the ads for. It's a good way of keeping track of older actors as they become much older actors, because they always get that job of selling these things. A reverse mortgage is simply a mortgage where the bank pays you some money up front, takes the mortgage, but then you never really have to make a payment in your lifetime. They keep charging it interest, though. And when you die, your estate would owe all of that money that's accumulated, all of the interest that's accumulated. Additionally, you normally have the obligation while you're living in the home to pay the taxes and insurance and to live in the home. So it really does reduce your options. It's maybe a good option for some people depending on their financial situation. I'm sorry, my dog is barking in the background here. I can't control him. But I just very much caution you because the fees are astronomical compared to other mortgages. It's a very expensive product, and there's oftentimes a better way of accomplishing what your goal is there. So I'm not sure that there's ever a great time for a reverse mortgage, but I'd just be very cautious about that. Now, I believe that we are going to be switching over to talking about when things go bad financially, and Steve and I are going to talk about the next tip 7, dealing with foreclosure and bankruptcy.
And John, just before we get into that, I'll just note again for folks watching, I apologize again, everybody. We're still having a little trouble, I think, with the slideshow. So it looks to me, John and Elisa, like it's just 3 heads in a box right now. We'll keep doing that, and I'll just note that we are on slide 10 and tip 7. And John, you take it away.
All right, sure. Well, I think these are both giant issues that if you or a friend or family member are facing foreclosure or threats of foreclosure, contact an attorney, contact us, or contact a housing counselor in the area, including home repair services. But just a brief touch on the foreclosure process. It is a long process that involves notices to you after you have not been paying your mortgage or something else has happened that the mortgage company decides is a default. Keep in mind that with a reverse mortgage, death is a default in a way. And so it's important that you understand your rights. You get notices before there's a sale. You have the right to be reviewed for loan modifications. If there is a foreclosure sale, you have a redemption period that lasts for at least 6 months, where if you are still have an ownership interest, you can redeem the property for what it's sold for at the sheriff's sale. That sheriff's sale is a very important kind of triggering event because if you are working with your mortgage company and just can't get it worked out, you can use a bankruptcy, and specifically a Chapter 13 bankruptcy, to stop the sale and kind of force a payment plan. But it is a very complicated area of law that we're not going to discuss in an hour. So I just want to touch on those things and keep in mind that when you're facing the foreclosure, It's not the end of the world. It's not a time to kind of panic and sit on your rights. The best thing you can do is contact some outside help and get good advice about what's going on and understand your rights. And finally, understand that at the end of things, a bank can't just come in and kick you out. They do have to go through a foreclosure or an eviction process as well. So you do have an opportunity at that point as well to challenge what they've done and make sure that it's legal. But you certainly want to act sooner rather than later in that whole process.
All right. Thank you, John. Thank you, Elisa, both for covering a whole lot of home finance issues in these past few tips. And as we go forward now, I think what we'll do is we'll move on to, this would be slide number 11, Elisa, and we'll turn to some everything, I guess, comes down to money, but this at least is not a direct finance issue. So let's turn things around and go to home repair issues with slide 11, tip B.
Perfect. So there are some frequent home repair issues that come up for most homeowners. I feel like that's one of the biggest reasons why people don't want to buy a home sometimes. But things come up. And that's the case for rentals as well. But in this case, for homeowners, you are responsible for it. That's the only difference. But one thing that I would like to say about that, or a couple things, just be careful with who you hire for your repairs. Make sure that you get quotes from people who are trustworthy, that have a license to do repairs, not just anybody, not just your cousin who learned to do drywall last week, right? You want to make sure that you have the right person to do the job. If you are changing the footprint of your home, you have to file permits with the city or the township, and there's just a lot of paperwork that is involved with that. And the right contractor will make a huge difference in this sense. So just make sure that you're, you have all your bases covered. And that's what I'm going to say about that portion of it. The other part of it is for the different, the different segments of our community. It's different what we qualify for, right? So the services that we have at Home Repair Services, we do have a repair program. It does have income limits, but basically what we do is we work on basic repairs on a home. There is a copay involved for every single service that we provide. So people do have to come up with the money for that, but it's generally based on your income. So if you're interested in knowing that, I would advise you to either call us or look at our website as well. But basically, there's a repair program. We also have a kitchen remodeling program that is a free program, but there might be a waiting list for that one as well. For the Fix It School, we do have usually workshops that teach you how to do things in your home. So from changing the light bulb to actually opening a new or putting up a new light bulb in your room, right? Like doing the installation for that. So there's a lot of the basic repairs that you can do yourself. You can learn to do yourself. These ones are not available right now because you do need to be in person. So we're still, if you're interested in those, just keep calling us and try to find out about those, because we can't do them in person. This is something or we can't do them online. This is something that you have, it's a hands-on experience sort of thing. But those are free generally. There is also a home maintenance checkup that is free. It's basically like a home inspection, but for a home that you already live in. So it's just someone from our organization going to your home and kind of pointing things out to you of repairs that you might need in the future and how to plan for those. And I think we're moving on to the next slide.
And you're right, Elisa.
Yeah.
I think we're going to jump 2 slides to slide number 13
Perfect.
now, and John will pick it up with a real fun topic, property tax.
I still have more.
Oh, I'm sorry, Elisa.
Sorry, I just meant the slide. So with the same tip, just continuing what services we have, Some other programs that we have at Home Repair Services that are not necessarily for repairs is our housing counseling program for anybody who is struggling with a foreclosure, be it tax foreclosure or mortgage foreclosure. That's a service we do provide, and that is free as well. And we do have a financial capabilities workshop that we teach, and actually John is part of those people who help us teach that class. That one is $10 per household, and it is a certificate series and it's used for different programs. So if you're required to take that, that's also available at our organization. And the Money Matters workshop, and those are free, but you do not get a certificate of completion for those. And then I do want to mention a couple other programs that might be around in Kent County for homeowners as well. That might not be, something that you find advertised on the highway or whatnot. But there's the housing rehabilitation program from the city of Grand Rapids, and they sent this to me, and I didn't put it in the slide. But the city of Wyoming also has a program that can help homeowners with repairs in the home, or fixing things in the home. But those will usually have it's kind of a loan program. There's a neighborhood impact program and the accessibility modification program, and those are two grant programs that you can apply to. So I'm just mentioning them so that you can look them up. All of the programs will have some income limits and location requirements as well. So I just want to mention some of them so that you have them in mind and you can look them up and really, do some research about those. So now it goes back to John.
All right. Thanks, Lisa. Now, I guess I'm going to talk about property taxes to keep everybody wide awake. And again, this is another very big area, but there's only really three things I'd like to touch on briefly. As most of you probably know, there is, anytime you have a primary residence in Michigan, there's a fairly significant tax break, for lack of a better term, that you receive called the principal residence exemption. Occasionally I get people coming into our office who've never gotten that tax exemption. So it's worth checking on if your taxes are high, or if there's something odd about your home ownership. Honestly, the times that I see it are usually people who are buying a house on a land contract, or are, receive the house from a family member and it's part of an estate or a trust. In which case, while they should be getting the principal residence exemption, the city just doesn't recognize it because they don't have the documents. So you should be able to contact your city and get that exemption. And one nice thing about it is that if you identify the fact that you should have been getting that, we call it the PRE, they can go back, I believe, 3 years to reimburse you for those taxes that you paid up to 3 years ago. Another program that is very under advertised and overly complicated is the poverty exemption. If a person has meets federal poverty guidelines, they can apply to their city or township, if they're outside of a city, for an annual poverty exemption and not pay any taxes, property taxes. And again, it's incredibly underutilized. And the townships and cities are supposed to be putting those applications online. My experience is that they do not. There may be an exception if the city or township is not generally online themselves, that they don't have to post it online. But even the places that are larger municipalities that really have no excuse, when I've looked at it, have not been posting those online. So you sometimes have to go to the assessor's office to get an application. The applications are fairly short, so they're not that difficult to complete and submit it. And that is, again, 100% reduction if you're under that income guidelines.
Just to add one more thing going wrong, we might have lost John there for a second. John, are you back with us?
I can hear you. Can you hear me?
Yeah. We just had you freeze up for a sec, but you're back and you're all good right now.
Right.
What else could happen?
I was giving the golden nugget of the evening in advice, and it happened anyway. So all I was saying is that that you submit that taxes, and if you're below the poverty line, it should be a 100% abatement basically of your taxes. Cities can provide a more generous poverty exemption above basically more income than the poverty guidelines. And when they do that, they can give you less than 100% abatement. They can abate it by a smaller amount. But that application is annual, but you can submit it any time of the year. I think the cities that I've looked at review them in February and July. So you have plenty of time now to do that application, but you do have to do it every year, even if you know you're going to qualify. Sorry. And you also can't go back in time. And then the final thing to keep in mind, and this is just, again, a very brief note, that if you do not pay your property taxes, eventually it will go through a property tax foreclosure, which is different than a mortgage foreclosure. You would be getting those notices right now. That process, starts in March and basically runs very quickly, and you can lose your interest in your home very quickly in March. So do make sure that you are paying your taxes, or if there is a reason why your taxes should be reduced, send those applications in now and get that taken care of now. Do not wait. And yeah, our last tip of the night, then we're going to move on to estate planning. And this is not a very in-depth, again, review of estate plans. That's a whole different conversation, but mortgages and deeds all come into play with estate planning. If you are a person who doesn't have a whole lot of assets other than your home, but do own your home, you can transfer it by using a deed, basically deeding it to yourself and whoever you would like to have own the property, and that avoids probate issues. Do consult with an attorney before you do that. There are some significant reasons why you may or may not want to do that, but keep in mind that that is an option. We get these cases every day. If a family member of yours passes away, and you knew that they wanted to give you the home, you're living in the home, but they did not have a will, you will have to go through the probate process and follow the probate rules, or I should say, even if they had a will but did not transfer it through a deed, you would have to go through the probate process and either follow the will or follow the probate rules. Also keep in mind that if you don't have a will, if you do have a will, for instance, you can give the property to your best friend or somebody else. If you don't have a will, then the state of Michigan doesn't care what you wanted to do with it. They will follow their step-by-step process, and it only looks at basically your blood relatives, not the people that you consider close to you. And ultimately, if there aren't any blood relatives, the state takes your property. Finally, keep in mind that as a person who may be an owner of the property after a family member has passed away, you still have to deal with that mortgage. If it's a regular mortgage, you can assume it, but there's a process behind that. If it's a reverse mortgage, basically the death of that person is a ending of that mortgage loan, and so you have to find a way to refinance that home to keep it. Otherwise, you could lose it through foreclosure. So now that we have talked about death and taxes, I think that is about it. I'll turn it back over to Steve to wrap up.
Great. Thanks, John. So we'll move things along now. We'll just go to the next slide, which is slide 14. And at this point, we just wanted to see if there were any questions that had come in during the program besides, hey, what's going on with the slide? And Kip, I'll turn things back over to you to check in on that.
Hi, can you hear me?
Sure can.
Okay, great. Well, sorry for all of the tech problems. We haven't had any questions, though.
Okay, good stuff. I think then, Kip, on our end, what I'd like to do is just say thanks to John and Elisa Thank you, folks, for tuning in tonight, and thank you very much for your patience as we were going through the slides. And Kip, thank you for having us here.
Yeah, thank you so much. Thank you for being a part of the program tonight, everybody. Again, sorry that we had the troubles, but we will try to make sure that we can post these slides for you. And again, we thank our partners so much, and check out our other programs at kdl.org/events.